Hello, this is Cynthia Fick, and this is the March 4th stock market update. Well, again, we have a lot going on in the market. I'm sure a lot of you are wondering what Financial Life Planners thinks and is kind of projecting for where the market might go here. As we know, the first 100 days of Donald Trump's presidency, no matter what your politics, it's been a little volatile. Some people perceive the tariffs, obviously the market perceives the tariffs as very uncertain, and the market doesn't like uncertainty. It may be perceiving Doge and the actions there as, very strong austerity. It's leading companies to feel like they can't spend as much money, and that affects the stock markets and their, company's price. So those are some of the things going on. Add on top of that, that we may have a government shutdown next week. And we have a big jobs number coming out on Friday. It's one of the biggest things that the Federal Reserve looks at in determining whether they're going to lower interest rates or not. The one kind of, silver lining, if there is one right now, is that interest rates have come down a little bit, and that may be affecting mortgage rates. The housing stocks are up, and it's kind of an interesting thing. So this is kind of what we're dealing with right now in the market, and why, again, over when, 2 weeks ago when I talked, Matt mentioned it, Gina mentioned it last week. Some of you had drifted to have way, too much in stocks for your risk tolerance. And so we've been skimming back on that. And it only affected maybe 25% of you. So if you didn't see something happen then you were at your risk tolerance. So that's just taking a little of our kind of money off the table and, putting some of our gains to the side, which is always a good thing, no matter what you're doing. And here's the things we will be watching and looking at to determine if we need to take more money off the table and get, more defensive. Because we don't want to have a knee-jerk reaction and make some really bad decisions, because the market is, starting to come down a little bit. We want to have a more measured, prudent approach. So that's what we're always trying to do. So here, let's look at the charts, and I'll just give you a little idea. These are two of about 30 things I watch to determine if we should get more defensive, okay? Okay, so this chart goes back to 2023, and it's a chart of the S&P 500. You can see here is where we have the election gap. When President Trump won, the market immediately jumped up, has given up, a lot of that gain that it had. And this is last week. So right now, today, as we speak, we are closer to this level on the S&P 500. So we've come down. This represents about a 6% drop in the S&P 500. Again, I told you we get 5% drops 3 times a year. We get a 10% once a year. And so that's, just normal, healthy stock market activity. What can make it a bigger deal if we start to break through some of these other lines. These are the kind of things we're watching. To go down about 10%, we're looking at coming down around in here, which would be our 250-day moving line. Haven't done that for a very long time. So this is where we start to go, okay, you got our attention. This is interesting. Do we need to get more defensive? And those are the kind of things I'm watching for, okay? I'm gonna also pull something that is a lot, people very familiar with this, that have been with me for a long time. I'm gonna pull it back out again because it's a really easier, simpler way to think about what's going on in the stock market. Okay, this is we call it the bull bear indicator. And as you can see, it went bear way back in October 2000, and you drop down to the S&P 500, you see when it went bear, the market proceeded to go down. It went bull in March of 2003, and that meant get in the market, buy, bullish, and the market proceeded to go up. So it's been pretty darn accurate. The only time it didn't go negative when I did is when, I had started getting defensive when we had the 2020 COVID crash. I think it's because it was so fast and quick and kind of unexpected. Anyway, it's been very accurate here. So at this point, this is, where we're in the bullish level, and I'm sure we've come down into this zone between the bullish and the bearish. And it would take, probably going down that 10% to get anywhere near this indicator going bearish. So these are kind of things we're watching. Again, that's what helps us to make a more measured, prudent approach. We're not just going to knee-jerk reaction, sell everything we have, but to start skimming some off, especially for those that had gotten overweighted equities, is our first strategy. These are things I'm watching, and we'll be reporting to you as we go along. Have a great week, and we will talk to you next Tuesday. Bye.